So welcome everyone to this special deep dive. We are on a mission today for all of you retail investors out there.
Yeah, a very specific mission. We are breaking down the Q2 2026 earnings call for Crocs. Ticker symbol is CROX.
Right, CROX. And if you've listened to Talk Tickers before, you know our rules of engagement here.
No Wall Street jargon, none of that, corporate speak.
Exactly. We are data forward, we are opinionated, and we keep it concise. So we're extracting the signal from all the corporate noise.
Because there's a lot of noise with this particular stock right now. I mean, this is not just about foam clogs anymore.
No, not at all. So, how does a footwear brand get hit with these massive geopolitical tariffs, suffer a huge drop in profit margins, and then intentionally starve its wholesale channel?
While still posting a record-breaking $1.2 billion quarter. I mean, it's crazy.
It is, and the stock is soaring. So today we are dissecting how management turned this, seemingly disastrous macroeconomic setup into an absolute masterclass.
Right, a masterclass in capital allocation, and really just operational agility. Because at first glance, the initial reaction from those algorithmic trading bots to the margin drops.
Oh, they usually trigger a massive sell-off, right?
Exactly, a total dump of the stock.
Yeah.
But when you read the actual transcript, the underlying mechanics show a company fundamentally restructuring its revenue quality.
Okay, let's unpack this, because I want to push back a little bit. If you're a retail investor holding this stock and you see margins drop, you panic.
Oh yeah, you think pricing power is just evaporating.
Right. But before we get into the bleeding margins, we got to look at the top line demand. So, headline numbers. Enterprise revenue hit a record $1.2 billion for Q2.
Which is huge. That's up 2% on a constant currency basis.
No, wait, constant currency, that's doing a lot of heavy lifting there, isn't it?
It really is. Because, Look, the US dollar right now is incredibly volatile against the euro, against the yen. So when you translate those foreign sales back into dollars, it can artificially make your growth look terrible.
Right, it deflates it. But if you strip out those exchange rate fluctuations, what you see is that actual consumer demand is expanding.
Yeah, the sheer volume of footwear moving out of the distribution centers is legitimately growing. It's not just some favorable accounting trick.
And the breakdown of that demand is what totally caught my attention. So Crocs Inc. operates two major brands, the namesake Crocs brand and Hey Dude.
Right. And the Crocs brand just crossed a massive milestone.
$1 billion in a single quarter for the first time ever, up 4% year over year.
$1 billion in 90 days, mostly from molded foam footwear. I mean, that forces Wall Street to completely reevaluate their total addressable market.
Because, 10 years ago, everyone thought the clog was a fad.
Totally. Just a gardening shoe with a hard ceiling. But hitting $1 billion in a quarter proves this is a globally adopted consumer staple now. It defies regular fashion cycles.
But then there's the other side of the ledger, Hey Dude.
Yeah, the problem child of the quarter.
Right. So Hey Dude came in at $179 million, which is actually down 6% from last year.
Which management tried to spin. They framed it as beating internal expectations.
Yeah, but come on. If you're an investor and you see a brand acquired specifically for high growth shrinking by 6%, you need some answers.
Oh, absolutely. And we're going to dig into why that contraction happened because, spoiler alert, it was entirely intentional.
Right, but the market didn't punish them for the Hey Dude miss. And that's because of the bottom line. Adjusted diluted earnings per share came in at $4.55.
And that EPS number, that is the pivot point of this entire report.
Because they guided for what, like $4.15 to $4.30?
Exactly. So $4.55 isn't just a beat. They absolutely demolished their own projections.
Wow. And in retail, beating EPS by that much usually means you either had a crazy surge in spending or you just cut costs to the bone.
Right. And given the consumer environment right now is super tight, that earnings beat points directly to insane internal operational leverage.
Which brings us to the big anomaly, the scary part. How do you crush earnings per share while your gross margins are literally shrinking?
Yeah. Enterprise adjusted gross margin dropped down to 60%.
170 basis point drop. And Hey Dude took a brutal hit, right? Down 650 basis points to 43.7%.
Which is terrifying on paper. Shrinking gross margins usually mean you are heavily discounting your product.
Exactly. It means your inventory's stale, consumers won't pay full price, and you're just dumping it.
And if that were true here, the long-term thesis for CROX would be totally dead.
Okay, so translate the jargon for us. What is actually bleeding the margins if it isn't discounting?
It has nothing to do with promotional discounting.
Right.
Out of that 170 basis point drop, 160 basis points were driven entirely by tariffs.
Tariffs.
Yeah.
Wow, so it's a geopolitical headwind.
Exactly. It's a direct tax on their supply chain. When the footwear crosses the border, the government levies a tax.
And if they're importing from hubs that suddenly get hit with higher duties, their cost of goods sold just spikes.
Right. And Hey Dude absorbed a huge amount of that impact because their supply chain is way less mature than the Crocs brand.
Because Crocs has factories everywhere, right?
Yeah.
Vietnam, Mexico, Indonesia.
Yeah, they have built-in redundancies. So if a tariff hits one region, they just shift production elsewhere quickly.
But Hey Dude can't do that yet.
No, they are stuck with legacy manufacturing routes from before the acquisition. So when tariffs hit, they didn't have the agility to reroute. Bam, 650 basis point margin implosion.
Man. So they're basically eating a massive tax bill just to get the shoes into the U.S.
Yes, and mathematically, if your costs spike by 160 basis points, your profit should tank.
But they beat EPS by 25 cents, so they had to claw that money back somewhere else. How?
A two-pronged strategy. First, aggressive supply chain savings on the front end, renegotiating factory prices, optimizing container loads.
So squeezing every penny out of the logistics before the product even hits the customs border?
Exactly. And the second prong is even more impressive. Strategic international price increases.
Oh, wait, so they absorb the U.S. tax by raising prices in Europe and Asia.
You got it. And the fact that they successfully passed that cost onto the global consumer without killing demand, that proves their pricing power is intact.
That's incredible. If you can raise prices in a tight economy and volume holds steady, your brand equity is basically made of iron.
It totally invalidates the fear that they're losing pricing power. The product is highly inelastic overseas.
Which perfectly segues into the story behind these numbers. Let's look at the channels, direct to consumer or DTC.
Yeah, Crocs brand DTC grew 12% globally, and Hey Dude DTC grew by 7%.
And the CFO specifically pointed out that the Hey Dude DTC growth happened with lower performance marketing spend.
Which is the holy grail for digital retail right now.
Seriously, everyone is trapped in this nightmare of paying Meta and Google just to keep baseline traffic alive.
Right, the customer acquisition costs are insane. But if Hey Dude is growing DTC by 7% while spending less on those digital toll booths,
it means people are organically searching for them. They're seeking the brand out intentionally.
which fundamentally changes the profitability of the transaction.
Yeah.
You don't have to pay a tech platform $30 to sell a $60 shoe anymore.
And looking at the map, international revenue for Crocs was up 7%. China, India, and Japan all saw double-digit growth.
Because North America is mostly a replacement market now, but China and India, that total addressable market is massive.
And they aren't just selling clogs there either. The product diversification is wild. Sandals, right?
Oh, sandals are exploding. Management says sandals will be a $500 million business this year alone.
$500 million just on sandals, taking huge market share with the Miami and the Brooklyn styles.
Yeah, the global sandal market is like a $30 billion industry, but it's super fragmented. Hundreds of tiny brands fighting for single digits.
And Crocs is just coming in using their proprietary molded foam and building a monopoly in a category that gets recurring summer purchases.
Exactly, turning a fragmented market into a branded cash machine. But we need to talk about the Hey Dude wholesale dilemma.
Right, the intentional shrinkage. So Hey Dude overall dropped 6%, but the wholesale channel like big box stores plummeted by 17%.
And management is literally calling this 17% drop a victory.
Which sounds insane. A 17% drop in your main channel is usually a catastrophe.
It is, but you have to look at what happened before Crocs bought them. The old management just flooded the market with inventory.
They stuffed every discount retailer and strip mall they could find just to inflate top-line sales.
Right, they completely commoditized the brand.
It makes me think of, it's like cleaning out a hoarder's garage before you can park a new car in it.
That is the perfect analogy. You can't position Hey Dude as a premium brand if a customer walks into a discount store and sees a wall of them for 50% off.
So they are intentionally starving the wholesale channel, terminating discount accounts and pulling back inventory.
Executing a controlled burn of their own revenue, taking a huge short-term hit to clean up the channel.
Taking the medicine now, because once the channel is clean, the only place to get the shoe is direct from Crocs at full price.
Where they capture the full margin and own all the customer data.
But wait, if you're cutting marketing spend, how do you drive people to your direct channels?
Social commerce. They are completely bypassing legacy ads.
Oh, the TikTok stuff in the transcript. They mention these micro dramas.
Yeah, native serialized short-form fictional shows on TikTok. Their first one, Charmed to Meet You, got nearly 20 million views.
So they aren't just running static ads that people skip. They're making actual entertainment.
And the conversion mechanism is flawless. You watch a 3-minute drama, you click the product tagged in the video.
And you just check out right there on TikTok Shop. You never even leave the app.
The friction between impulse and purchase is reduced to absolute zero. They even hosted TikTok Shop's first global super brand day.
This feels like a structural advantage, blurring the line between retail and entertainment.
And it's dirt cheap compared to a traditional TV ad campaign, but converts way higher.
Plus the collaborations. They sold out that Bait streetwear collab in minutes. And the F1 Red Bull racing shoes.
They even became the official shoe of the National Hacky Sack League.
I saw that. Leaning into the absurdity. It's cultural engineering at this point.
Letting virality do the work, and then harvesting the demand with zero friction checkouts. Which brings us to the forward guidance.
Yes, Section 3. Wall Street trades on tomorrow, not yesterday, and management hiked their guidance across the board.
They raised full-year enterprise revenue expectations to 1 to 2% growth.
And the Crocs brand specifically to 2 to 3%. But the real leverage is the bottom line. Full-year EPS raised to $13.70 to $14 a share.
If you are holding the stock, this is everything. They're promising to extract more pure profit than originally modeled, despite the tariffs and the Hey Dude shrinkage.
Speaking of Hey Dude, they raised that outlook too, from down 5 to 7% to down only 2 to 4%.
Which means mathematically they are projecting a massive return to positive growth in the second half of 2026. The controlled burn is almost over.
Okay, here's where it gets really interesting though. There's this accounting quirk happening in Q3 that we need to warn you about.
Yes, the business model shift with a major marketplace partner, likely Amazon.
Right. Starting next quarter, they're changing how they recognize revenue there, from a 3P model to a 1P model.
Under the old 3P model, Crocs essentially treated Amazon like its own digital storefront.
Yeah.
They sell a shoe for $50, they record $50 as DTC revenue.
But then they have to pay Amazon massive shipping and platform fees, which eat the profit. It's like moving money from your left pocket to your right pocket and dropping half of it on the floor.
Exactly. So the new 1P model changes everything. Instead of acting as the retailer, Crocs will just sell the inventory directly to Amazon at a wholesale discount.
And let Amazon handle the pricing, the shipping, all of it.
Right. So on paper, the top line reported revenue is going to instantly shrink in Q3. DTC growth will look like it's decelerating.
But, and this is the kicker, because they shed all those Amazon fees, their actual bottom line operating profit will increase.
It's an optical illusion. They are sacrificing top-line vanity metrics for high-margin cash flow.
If you don't understand this, you're going to see the Q3 headlines, panic about revenue missing, and sell. But It's actually a brilliant move for the bottom line.
What they are doing with that resulting cash flow is incredible. Capital allocation.
They paid down $31 million in debt, putting net leverage at the absolute low end of their target.
In a restrictive interest rate environment, having no debt frees up a massive amount of operational cash.
And what are they doing with it? The board just authorized a new $1.5 billion share repurchase program,
bringing their total buyback capacity to roughly $2 billion. This is huge.
If we connect this to the bigger picture, a buyback of this size fundamentally alters the valuation.
It acts as a direct multiplier on EPS. They take free cash, buy their own stock, and retire it.
Which shrinks the total number of shares. So your net income is divided by a smaller denominator. Boom, your earnings per share goes up without selling a single extra clog.
And when EPS goes up, the price to earnings ratio drops. The stock mathematically becomes cheaper, which brings in the institutional algorithmic buyers.
It's basically management screaming at the market, we think our stock is severely undervalued.
It puts a massive $2 billion floor underneath the stock price. If the market dips, management just buys the dip and accelerates the value for remaining shareholders.
So bringing it all together, the bottom line, the verdict.
It's very, very bullish.
Strongly bullish. If you are holding or considering CROX, this transcript is gold. They absorbed a tariff hit that would have destroyed a weaker brand.
They offset it with international pricing power. They are taking over the sandal market.
And Hey Dude is successfully finishing its rehab stint. They are using their absurd cash flow to buy back stock at scale.
They transitioned from a one-hit wonder to a global juggernaut.
But before we wrap up, I want to leave you with one final provocative thought from the closing remarks.
Oh, the AI detail.
Yes. The CEO casually dropped that they are testing AI-enabled shopping experiences across ChatGPT and Copilot.
And the initial data shows these conversational AI interactions convert way higher than normal web browsing.
Think about that. You aren't typing into Google and scrolling links. You just tell an AI, hey, I need a comfortable waterproof shoe for my vacation.
And the AI, which already knows your size and history, generates a one-click purchase link directly from Crocs.
Bypassing the search engine, bypassing the wholesale retailer, bypassing the physical store completely.
Crocs captures 100% of the margin and all of the behavioral data.
So as you look at your portfolio, ask yourself, are we watching the extinction event of the traditional brick-and-mortar shoe store?
When a footwear brand becomes a pure tech and content ecosystem, it definitely looks that way.
Keep your eyes on the data, ignore the noise, and we will catch you on the next Dip Dive.